So taxation of insurance company. So we're going to do taxation of insurance company, and we shall start with the definition of insurance. What's an insurance company? Insurance company, and we say these are companies. Just simple definition. Don't require this one in examination. Which insures properties and life. People's life. You can talk about people's life. So that's just a simple definition. Remember, when we talk about insurance, we're talking about common pool where members contribute. Then, in case of an emergency, then they will be compensated. So it's a company which insure people and property, just as a simple definition. So that's a simple definition that we can use. Now, for tax purpose, we have two types. So for tax purpose, it is classified into the following. It is classified into number A, general insurance. And number B, life assurance. So for tax purpose, it is categorized into two. So that one and that one. And then another statement for tax purpose. Comma, taxable income. Taxable income for general insurance will be computed separately. Will be computed separately. And from that of life insurance. From that of life assurance. So that's what you need to know. That for tax purpose, general insurance will be the taxable income for general insurance will be computed separately from the life assurance information. So don't mix. And then they are taxed at a rate of 30%, at a rate of 30% for residents, and that's 7.5% for non-resident. Okay, that one being said, you can say format. I don't know if the format is that was share, but we can use the space format. Let us see if the format will be able. So we start with the general premium received, not general, gross. So this is the format. Gross premium received. We add premium balance carried down. Then we less premium balance brought down. Then return premium. premium. So it tunafaa ku less turn premium, we also less reinsurance premium paid, reinsurance premium paid, reinsurance premium paid. Then recoveries from reinsurance, we add recoveries from reinsurance, we add, so that we get the figure you utapata inaitwa the net premium. Net premium inakuja hapo, so kiadi hizi zote will give this figure. So that's the net premium. Then we can add other income. So we add now other income. So the first income is commission received. Commission received. We have income from exercise of subrogation right. Income from exercise of subrogation right. Subrogation right. And then commission ceded. Commission ceded. We are supposed to add reduction in reserve. Reduction in reserve is also an income, but increase is an expense. Foreign exchange realized. Foreign exchange realized is also an income. Is also an income. An earned premium. An earned premium. Reduction in an expired risk. Reduction in an expired risk. And then we have another one, interest policy holder. Interest on policy holder outstanding premium. Interest on policy holder. Interest on policy holder outstanding premium. Outstanding premium. Premium. Hii nikisongesha kidogo hapo tukulie space yetu bure. So napata total income. So get the total income. Then once you have the total income, you less allowable expenses. Less the allowable expense, and the first one is the claim. So that's a claim paid. Unaweka hapo claim balance brought down. Balance carried down. Then claim balance brought down. Balance brought down. Then the figure inakuja hapo as allowable deduction. Then claim recovered. Claim recovered. Claim recovered by reinsurance. By reinsurance. Commission accepted. Commission accepted. Commission accepted. Legal fee kama iko. Maintenance fee, entertainment fee, capital allowance, blah blah blah. And also so unapata hiyo. Then you less capital allowance, then you less. So because this one is tunaanza na gross profit method, we are supposed to add. We add other income. So we are supposed to add other income. For example, we can have something like interest, rental income. Just say rental income. We have more. So it depends on the question, but I assume we have just one. Now we get the total taxable income. Total taxable income. Total taxable income. Therefore, tax payable is 30% of XXX, this one. So that will be the value of the tax payable. That one will be the value of tax payable. So that's the general format of the, and this one is for the general. So remember, this is the format for general insurance. So remember Japan Life. This one is for general insurance. General insurance. So I want to do away with this one so that we can talk about the life insurance. So I want to do away with this one so that I can talk about the life insurance policy. Life insurance. And then maybe we can do a question to cement that one. So that we can do a question so that we can cement this one. So that one is fine. So that is the format actually. Hiyo najua haina mambo. So the format is okay. So let us talk about life. So tumefanya general insurance. So we can go to the life assurance. Policy. So life assurance policy. Now this one is a bit different from the other one. So this one involves insuring people. So you can say involves insuring people's life. For general, remember for general involve insuring properties or like vehicle, houses, and so on. But in this one, specifically focus on insuring people's life. Now, taxable income. Taxable income of life assurance consists of, so it consists of the following. Number one, any surplus recommended, any surplus recommended by an actuary. Actually, those are expertise in insurance. I don't know if that is the correct spelling. To be transferred to life assurance. To be transferred to life assurance. Transferred to life assurance for the benefit of shareholders. For the benefit of shareholder. Underline the word benefit of the shareholder and surplus recommended. So kama haina hiyo vitu, then that one will not be a taxable amount. So kama haina hiyo vitu mbili imeunderline and transferred. So kama haina hizo vitu tatu, kama one of them is missing, then that one will not be a taxable income. So number one, a taxable income must consist of the following. Number one, any surplus, and it must be recommended by an actuary. So it must be recommended by an actuary and transferred for the benefit of shareholders. Number two, any amount transferred, any amount transferred, any amount transferred for the benefit of shareholder, for benefit of shareholder. So any amount transferred for the benefit of shareholder, and then ya mwisho 30% of 30% excess of management fee, 30% of excess of management fee. Management fee, or you can have management fee, or you can also have a commission expense. Commission expense, where which is the amount, which is amount recommended, which is the amount recommended by Insurance Act, by Insurance Act, by Insurance Act, and it is based on net premium, and it is based on net premium as follows: of life business, as follows. So management expense, unachukua management expense, you less the recommended amount, then this amount you get, unachukua 30%, you take 30%. So 30% of this amount, that's what we call that is the excess, 30% of the excess management fee. So management fee, you less the recommended, we get the excess fee. So this excess fee, the 30% is what is recommended. So excess fee, this one is taxable income. So we call it taxable income recommended. So we have three of them. So number one, any surplus recommended by actuary and transferred to the benefit of shareholder. That's number one. Number two, any amount transferred for the benefit of shareholder. And number three, when you take your management fee, then you less the recommended amount by the insurance company, then 30% of that amount will be the benefit for the life insurance. We have three of them. Now the question is, how do we get the recommended amount? Computation of recommended amount. Computation of recommended amount. Computation of recommended amount. Computation of recommended amount. Computation of recommended amount, and you can say it will be computed using the following table. It can be computed using the following table. following table. So tunasema net premium of life business. So first 5 million, next 7.5 million, next 7.5, and then next 10 million, then excess of 30 million. Rate of management and commission expense. Rate of management and commission expense 25%. 25%. Then you have 22.5%, 20%, 17.5, now 15.5. So be very keen with that one. Now I think we can do a question. Let me confirm with you something. Let me confirm with you. Where is it? Aha. This is about life insurance. Life insurance. Just a moment. So let us do the question for November 2016, question number 5C. November 2016, question number 5C. November 2016, question number 5C. So November 2016, question number 5C. The question says, Sunny Insurance Company Ltd. is a resident insurance company firm carrying out both general and life insurance. The following information to the insurance business for the year that 1st December 2015. So we have general and life insurance. We have the information there. Then you have the additional information, and then required the taxable profit and loss. So you're going to write Msanifu Insurance Company. Tutasema Msanifu Insurance Company, computation of taxable income for the year. The year is 2015. The year is 2015. The amount is in thousand. The amount are in thousand. So we can start with the first one. So we start with the format. We start with the gross premium received kama iko. So we start with the gross premium. Gross premium received. Gross premium received. So we have the insurance premium received pale 15 for 50. So hapo juu ni 15 for 50. Then we check premium balance brought down. Tuenda kwa additional information, mostly inakuwa kwa additional information. Angalia kama we have the outstanding premium. No, we don't have any outstanding premium, but we have number 6, outstanding claims. So hizo zitaenda kwa expense. So we don't have any premium outstanding or any premium outstanding at the beginning or at the end. Then we can check if we have premium returned, yes. So we are supposed to less premium returned, returned ni ngapi? Premium returned ni ngapi hapo? 374. 374. Then we check if we have reinsurance premium paid. Reinsurance premium paid. Reinsurance premium paid. Yes. Premium paid to reinsurance company 4680. So reinsurance premium paid. Reinsurance premium paid 4680. I think it is 4680. Then you check if you have the recoveries from insurance. Hakuna recoveries. Yes, we have pale chini recoveries from reinsurance 150. We add recoveries, so add recoveries from reinsurance. Yeah, 150. So that we can get the net premium received. Inaenda hapo as our income. So tunasema 15450 minus 374 minus 4680 plus 150. So this one is equal to Kenya shillings 10 546 10 546. I think that one is the correct amount. 10 546. Now we can look for other income now. So another income now, other incomes, for example, is commission received. Do we have anything like commission received? Investment income pale juu unaachana nayo. That one does not relate to the insurance. So commission received. Yes. Yeah, 1360. Reinsurance commission received 1360. Reinsurance commission received received 1360. So we add that one. We also check if you have income from subrogation right. Yes, we have income from subrogation right. Pale chini 1250. Income from subrogation right from exercise of subrogation right. Subrogation right. Natumia tu ile format yenye niliwapea 1250. 1250. We also check if you have commission ceded. Check if we have a commission ceded. I think there was no commission ceded. Commission ceded, there was no commission ceded. Reserves, unaenda kwa nini unaenda kwa information reserves. Information number 3. We have a decrease, so we have an increase actually. That's an expense. Hiyo hakuna kuangalia. So information number 3, it increased from 3240 to 6200. That's an increase, an expense. Hiyo tunaachana nayo. I think there is no any other form of income. So I think those are all the income. So we add them together. So let us add them together. So 10 546 plus 1360 plus 1250. Inatupatia 13156. So 13156. I think hakuna kitu kingine. Now we can less expenses. So less allowable expenses. And the first one tunaanza nayo ni claim. The first thing unaanza nayo ni claim. So unaangalia claim paid. The first thing, then you adjust that claim paid. So claim paid, tuenda kwa our information. So tukienda kwa our income statement, kwa our income statement pale, do you have claim paid? claim. Now hakuna, but tukienda kwa additional information, we have information about claim paid. Information number 4. We start with the information number 4. The claim paid during the period was 7,600. So we have 7,600. Then claim balance carried down. So we add, so those are the outstanding claims. At the beginning in 5640. Then we less claim balance brought down. That is at the beginning. So actually at the beginning ndio hii 5640. At the end ndio tofauti, nimeandika vibaya. At the beginning wanatuambia ni at the beginning ni 6,000. Do we have any other form of claim? There is no any other form of claim. So kama hakuna, we add the 3. We get the total figure of the claim. So 7600 plus 6,000 minus 5640 inatupatia 7960. So we less because it is an allowable expense. We less. So tukimaliza na claim, we can go to the others now. We can see if we have the claim recovered at any point. Claim recovered. So in additional information, we don't have anything to do with the claim recovered. We don't have anything to do with claim recovered. But kendo huko juu, do we have anything to do with claim? Hakuna. So tunamalizana nayo. Now kama hakuna hiyo claim recovered, tunaweza angalia commission accepted. So commission accepted also, sijaona kitu kama commission accepted. So hiyo hakuna. Commission accepted, no. Now you can go out with the other expense now. So in additional information, you have general expense, including computer, and so hiyo lazima tutoe. General expense is allowable. So general expense huko juu wametuambia ni ngapi? General expense 8490. 8490. Now we less computer 800 na furniture. Those are capital item. 800 na pia to less 1260. Those are capital item. So 8490 minus 800 minus 1260, 6430. Hiyo tumemaliza hivyo. Information number 3, those are reserve. Okay, reserve. Increase in reserve. Increase in reserve is an expense, but kama ni decrease it's a liability. So ilikuwa, so the increase, nataka kujua the increase ni ngapi? 6200 minus 3240. 3240. So 6200 minus 3240. That is 2960. 2960. Claims tumefanya life insurance, hiyo ni for life insurance. Hiyo tutafanya baadaye. So tunaweza enda huko juu sasa kwa our income statement, then we check other expense. So investment income tunaachana nayo, insurance management fee hiyo hakuna, premium return hiyo hakuna, insurance commission received hakuna, premium paid hakuna. We have agency expense 1350. Agency expense, that is 1350. Agency expense 1350. Management expense 1934. Yes, 1934. That is management expense. Traveling expense 1800. Traveling. Traveling expense. We have advertising expense also 364. So that is advertising. That's also allowable. General expense to refiner, budget specific 368. Allowable, specific. So budget specific. What else? All those are incomes, so tunafika hapo. tumefika mwisho. Okay, we need to list now WTA, capital allowance, that is capital allowance. Less capital allowance. Then once we less the capital allowance, we can add the other income. So we can add other income. So we add non-taxable income. So we add non-taxable income. Now before we add non-taxable income, let's do capital allowance. Now capital allowance ilikuwa tu ni mbili. And huyu hapa. Huyu na huyu. Walikuwa wamenunua computer na fitting. So computer ni 25% of 800 na fitting ni 10% of 1260. So hii ni 126. The other hii ingine ni ngapi? So hiyo unajuanga ni 0.25 times 800. 200. So yatupatia 326. So we are supposed to less 326 as our capital allowance. 326. Then we are supposed to add non-taxable income. Non-taxable income, or those which are qualifying meaning not subject to further taxation, So from that information, do we have any income? So investment income tutaanza nayo. Wajatuambia ni nini? Investment income. Wameandika tu investment income. Na make your work easier, mwandikie hapo non qualifying. Jisave hivyo unasema non qualifying kwa sababu hawajatuambia. Then we can look for other income. Ziko wapi? Haya. So we have something to do with interest on what? Interest. That was information number 1. Oh, investment income ndio umetuambia hapo actually. Hii investment income ina comprise of the following. Ile huko juu. Tuliacha huko juu. Kumbe hiyo ndio ametuambia hapo ya kwanza. Number 1 is fixed deposit account. Interest from fixed deposit account. Fixed deposit account. So that is interest from fixed deposit account. That is qualifying. So that is qualifying. Unakuja unaweka hapa interest from fixed deposit. This one is qualifying. So ni ngapi? 78,000. 78,000. The other income is dividend from tumepatiwa another dividend here na pia ametuambia ni qualifying. So kama ametuambia ni qualifying, hiyo mpaka ikuje hapo. Boom, where is it? Iko wapi hiyo dividend? Nimeona something. Dividend from qualifying company. This one is dividend from qualifying company. Qualifying company. What does it mean? Dividend from qualifying company. Tunaweza weka tu dividend qualifying company. Now dividend from qualifying company. What is the rate? So what is the rate for qualifying dividend? Qualifying dividend. Just a moment. So acha tuwadi kwanza, let us do this work tuone this figure kama ni positive ama negative before we add na taxable income. Tunasema 13,156 minus 7960 minus 6430 plus 2960 minus 2960 1350 1934 1800 364 368 326. So this one kwanza ni negative. First thing you need to know here, we are getting a negative figure. Minus 10,336. Kumaanisha we cannot aggregate this figure with these items. So hata kama tunasema we add, we shall not add them. We shall not add them because it is a loss. So we cannot aggregate this amount with the loss. So kumaanisha the final figure itakuwa, this will be the final figure. So the rate of the dividend, qualifying dividend. What is the rate of qualifying dividend? Now qualifying dividend is a rate of 5%. So kumaanisha that 3,000 given equals 95%. What about 100%? Itakuja ngapi? So itakuwa 3,000 times 100 divided by 95. So itakuwa ni 3,157,89. So total taxable income, So remember, this one cannot, the loss, if you made a loss, the taxable income cannot offset a loss. So utalipa tax ya hizi kando peke yake. The other one will be carried forward. But this one itakuwa, so the tax to be paid, taxable income, 3157.89. You shall pay tax of 81,157.89. So that's the amount of tax to be paid. So remember, the tax cannot be offset. You cannot offset tax. These incomes cannot offset any loss. So those income cannot offset any loss. So that's all about that part. So tax payable is 30%. So tax payable 81,157.89. So utalipa tax on the incomes alone and not on the loss. So itakuwa ni times 0.3. So utalipa tax ya 24,347.367. So loss cannot be offset. So this income cannot offset the loss. So kumaanisha hii loss uta-add hii loss utaweka kwa hizi figure. But kama ingekuwa ni profit, ungechukua pure profit wadi huyu na huyu. But because ni loss, hii loss itakuwa carried forward. But you shall add this and this, and then you compute the tax from that amount. So let's compute the last item. And remember, for us to compute the last item, we need to consider 3 items. The first item is the benefit determined by actuary. So information number 5, the life assurance fund valued an actuary of 300,000 of 300 million as far as December 2015. 25% of this fund is recommended as a transfer for the benefit of the shareholder. So that's number 1. So first, the benefit wamesema ni 25% times 300. So tuliweka in 1000. So let's just continue in 1000. Itakuwa ni 0.25 times 300,000. It is 75,000. I don't know if that is the correct figure, but I think that one is the correct one. Once you get that amount, we get number 2. The second amount is the any other benefit. And from this question, do you have any other benefit transferred for the benefit of the shareholder? Hakuna. So we go to the third one. So the second one haikukuwa nayo. So we go to the third one, excess of the management fee. So remember how you compute the excess of the management fee? Now we need to do a working. So tulisema tunachukua management fee, management and commission fee. So acha nisongeshe kidogo. 75,000. So we want to get the excess, ndio tuweke huko. So tunaanza na management fee. So hiyo iko kwa our income statement. Unaenda kuchukua income statement yetu. Huko juu kabisa we have some pale juu mtuambia insurance and management fee. For life insurance iko. For general ni dash, but for life insurance ni 25. Huko juu ukianza na investment income, huko juu inaanza na investment income, then insurance premium received, then insurance and management fee hiyo 25,000. So it is 25,000. So iko in thousand. Then now we are supposed to less the recommended. So we less the recommended. So we less the recommended amount. So how do we get? So we need to do a working for the recommended. So that is what I'm interested with. So working for recommended. So nafanya hapa recommended fee, so that we get the excess. Now we are going to use the schedule. Remember the schedule? So the schedule inasema hivi, the first 5 million. So iko in thousand. Remember it is in thousand. So kumaanisha mimi naweka in form of 5,000. Is that one correct? Mimi naweka in form of 5,000. So the first 5,000. Remember tunafika ngapi? Remember our item which we are considering is 25 million. 25 million. So tunaanza na the first 5,000 kwanza, which is wanatuambia ni 25%. Itapatia ngapi? So you multiply. Then tunaenda kwa next. Next tukienda ni 7.5, which is tunasema ni 7,500. Ukumbuke bado 7,000 plus this one hatujafika 25. So we are still within the bracket. 22.5. 22.5%. And then next ni 75 still times the percentage is 20%. Hiyo imefika? Unaenda ukiangalia, so ukichukua 7.5 plus 7.5 plus 5 inakuwa 20. Kumaanisha tumebakisha, so ukichukua huyu plus huyu plus huyu tumebakisha ni 20, tumebakisha 5. So acha tuone next. So tuone next. Next one anachukua ngapi? Tunachukua hiyo 5 yenye imebaki, 5 million. The rate ni ngapi? Ni 17.5. The rate is 17.5%. So tukishafanya hivyo, hiyo swali tumemaliza hivyo hivyo. There is nothing more or less. There is nothing more or less. There is nothing more or less. I think hiyo tuko sawa. So find the figure and you add them together. You find the figure and you add them together. Now, so the reason why nimechukua 5 ya mwisho, najua mtu ataniuliza hiyo, ni kwa sababu ukienda kwa the recommended rate of the actuary, the first one is 5,000 the way it is. The second one is 7.5. So ukichukua huu plus huu unapata 14.5. Not 14, 12. So huyu plus huu 12.5. Then next unaenda kwa 7.5 una add. Ukiadd hiyo unapata ni 20. So 20 ni kumaanisha tumeremain na ngapi? Out of 25 tumebaki na 5. So ukienda kwa the next one after 7.5 inafaa kuwa ni 10. Hii hapa inafaa kuwa ni 10. Lakini we are not interested with the 10 because sisi hatufiki 10. Tunafika 25. So inakuwa ni huyu plus huyu plus huyu. Then the last one inatupatia inatufikisha 25. So that's tumeweka 5,000. Then now you can get the figures. You can get the figures. So tunasema ni 5000 times 0.25 to 50. 7500 times 0.225 ala supposed to be 7500. This one is supposed to be 1687.5. Penyangu inaisha hii kwa wakati mzuri wakanaenda kumaliza 1500. So the amount recommended itakuwa the summation of hiyo 875. So we add to get the recommended. So 1250 plus 1687.5, 1500, 857. So this one is 5294.5, 5294.5. So that you can get the excess. So 25,000 minus answer, which is 19,705.5. So we can get that 30%. 30% of 19,705.5 inakuja hapo. So times 0.3. So you're supposed to less 5,000, 59, 11.65, so that you can get the taxable income of life insurance assurance. So that's the amount which is subject to tax. So it is 69,088.35. Remember our question is in thousand. So tax is 30% of 69,088.31. So what is the tax paid? 20,726.505. So that one marks the end of insurance company and life assurance. Maybe we shall do another one later, but for now we call it an end. So let us meet next time.